Our next session is, Bruce, you'll like this. It's about illiquid assets, not red wine. Okay. It's accommodating illiquid assets for your clients. So we've got Danny Wong from Alteris and Michael Karagianis from JANA. Welcome, gentlemen.
Thank you. Yes, this is designed as a fireside chat. And Toby, I must say that where's the fire? That was the only request we had today. This is a session that a couple, my colleague Duncan Smith did down in Melbourne, and we had another one of our clients here. For disclosure purposes, Danny Wong, who's Manager of Research at Alteris Financial Group. Alteris is a client of JANA's, a managed account client. He's kindly consented to come along and have a bit of a chat about illiquid assets. So Danny, welcome. Perhaps introduce yourself and I guess what Alteris does in terms of its business and client base.
Sure thing. So Alteris is a wealth management company. So we're specialised in financial planning, aged care, so specialised aged care advice, and also we've got a wealth accounting business. Bumping up to about 2 billion in funds under advice now. We've been early adopters of using SMAs. We run our own SMAs and MDAs. And then within the MDAs, we also use some unlisted assets, which is very topical, I think, from the earlier session as well. So, yeah.
And it'd be fair to say you've got a mix of retail and wholesale clients in your book.
Yeah, definitely. Typically, probably at the tail, your traditional mums and dads, but yeah, and then now sort of growing the wholesale type of clients, larger clients coming on board. So yeah, a bit of a mix.
And how do the SMAs get used for your client base? Is it a core satellite type approach, where all clients can really access the SMA as a sort of a core strategy, and then you look at what else you can populate for certain subsectors of clients?
Yeah, so on the SMAs, we run sort of multi-asset strategy, so using the risk profiles. Predominantly for certain types of clients, that will be the whole portfolio. But as Michael said, as we get bigger, I guess more sophisticated clients coming in, it can be a portion of that, and then building that as a core, and then satellites as well. So it's a bit of a mix, not necessarily just one size fits all. We do sort of try to cater. We also run bespoke portfolios as well. So combination.
No, good. And that really brings us to, I guess, the focal point of this session, which is illiquid assets. And there's a number of dimensions to it. I was going to perhaps give a few thoughts from a JANA perspective and then throw to Danny to give an Alteris perspective on illiquid assets in portfolios. One of the things I guess we observe in our space, and JANA is historically known as an institutional client. Over the last 5-6 years, we've moved into other client segments, and one of those is wealth. We tend to work with advice practices, private wealth groups that often do have a wholesale client component, and they want something a little bit more, perhaps in terms of the solutions available there. We've been investing and researching illiquid asset classes for a very long period of time, and I guess the reason for that is that our client base is attracted to those types of assets. They feel that there is benefit in terms of portfolio construction. We agree with that. We've done long-term research in terms of the benefits of illiquid assets in portfolios. People talk about that benefit being in two elements, I guess. One is, there is an illiquidity premium that is available, that by giving up liquidity of investment, that you can capture some sort of premium in terms of return. That may be because the underlying assets are able to be invested for a much longer period with comfort that they're not going to be prematurely redeemed, for example. It may give you access to investment opportunities that you just can't get access to in listed markets, very niche investments, particular projects, that sort of thing that we can certainly look at. The other aspect, of course, is the volatility aspect. And we know, of course, that listed markets are mark to market on a daily basis, intraday basis, and that does inflate volatility. It's sort of the old adage that, if you valued your house on a daily basis, you'd probably get more paranoid about its valuation because it would ebb and flow on quite a regular cycle. But people don't do that. But when it comes to equities, And fixed income and other traditional asset classes, of course, we expect daily valuation and we watch it daily to assess its value. And of course, long-term investors aren't constrained by that. And I'm not just talking about industry funds, superannuation investors. We also look at insurance clients, large family offices, and they are very long-term, in some cases multi-generational in terms of their investment perspective. And they can afford to park a lot more assets into illiquid assets, in liquid investments, and they ride out that volatility. And the mark-to-market is less of an issue for them, so why bother valuing it daily? You value it quarterly, perhaps every 6 months. And so the perceived volatility from those assets is a lot less. And this, you find anyone who's been comparing their performance of, perhaps their advised client portfolios against industry funds over the last couple of years, you've seen some very interesting dynamics. This year, for example, industry funds are lagging behind considerably because largely the less liquid part of their portfolios has really had that very delayed impact to the weakness, particularly in property and infrastructure over the last couple of years or so. So we think that there is value in illiquid assets. It is very much a case of trying to capture that illiquidity premium, but it's not a constant premium. It can ebb and flow. At the present time, for example, we would actually suggest that investing in property, there may actually be value in listed property as opposed to unlisted property because of the relative valuation or points of the valuation cycle we're at this point in time. But it's not just about property. It's also about private equity, of course. That's a large area of investment for many of our clients, and we see it increasingly in the wholesale space. Infrastructure, of course, Australia was the first country to really latch on to the benefits of infrastructure and direct investing in that space globally, but it has become a recognised asset class. But there's also other asset classes out there as well, and areas like insurance-linked securities, and we can talk a little bit more about that, where you're basically investing in the bonds that are issued against reinsurance risk effectively. It's not affected by economic cycle, it's affected by the ebb and flow of natural disasters. Royalty funds, another example of this. So it's an increasing landscape. One of the biggest problems, and this coming back to, I guess, your portfolios, is how do you actually put it into a managed account structure, or how do you actually accommodate clients that are interested in this when you're running a managed account structure? Because when we engage with our clients, a lot of them do want to see these types of assets, but it's notoriously difficult to embed it within either an SMA structure or an MDA structure. And I just wonder, what sort of thought process you've gone through in terms of looking at this particular issue and trying to nut it out, and how do you handle it in terms of accommodating investors here?
Sure thing. I mean, just a caveat, our first point of call is whether it's listed or unlisted, we're very open. Sometimes it's actually dictated by the investments that we're looking for might be in that unlisted bucket only, hence the discussion around illiquidity. In terms of SMAs, it's always a bit more difficult because we're in effect partly dictated by the platforms. Many of the platforms don't like unlisted funds in that space. They like the daily liquidity, and their REs are very strict on that. So in some ways, on the SMA front, that is a little bit more restrictive. In the MDAs that we've run, we have had unlisted in our portfolios. Obviously, to many of the points Michael highlighted, whether it be uncorrelated to all the listed stuff, different sources of returns, other things that we can get in there that's generally not available, is why we like potentially to use some of that in the MDAs. And generally also our MDAs are for our higher net wealth type clients as well. So I think there was an earlier discussion about how much is the right amount to have MDAs and the like. So that plays a little part of it in there. But I think the beauty of having that unlisted and then obviously dealing with the illiquidity is the different sources of other types of investments that we can have in that bucket.
And that MDA SMA nexus, I guess, is quite interesting because we've come across that as well in terms of running or advising on managed account programs on behalf of our clients, in that most REs that are controlling an SMA program will categorically say to you, you can't have anything other than daily liquidity in this portfolio. And that's pretty much a standard type of response. Now, at some stage that may shift in future, but at the moment that's generally the feedback that we get. MDAs are a little bit different in that it does produce potentially more flexibility, and we also run MDAs on behalf of a client that has a portion of illiquidity in it. Now, to put that in perspective, we're still talking about relatively liquid, so perhaps monthly illiquidity as opposed to daily. Certainly not lockup, sort of closed-end PE type fund structures. And I just wonder, in terms of your experience here, what sort of boundaries do you put on that illiquidity in terms of MDA investments?
Yeah, it comes back to how we run the portfolios across the risk profile. So we do have to be very cognizant of the exposures. So obviously, as you sort of come down the risk spectrum, we'll have less allocation. Probably the growthier ones, we might go up to sort of the 20-25%. And that's also never in just one investment. When we talk about the illiquidity type investments, it's across a number of different types and obviously across different subsectors too. So that's how we sort of consider it. And then ultimately too, it's really for us looking at the clients and their, I guess, cash needs. If you know clients that are coming up and there's going to be massive withdrawals, it's probably not the right type of assets to put in there. So again, it's probably having that longer term lens for that type of client set that has that time to sort of at least put that away. And again, from a risk perspective, it's never a huge amount of their portfolio.
And what are some of the illiquids that you look at in that context, say for your MDA program? I mean, we're talking private equity. Obviously, there's different types of private equity out there. There's the monthly liquidity type private equity opportunities, and then there's the closed-end structures where you're locking up capital for 3 to 5 years. Would that be potentially in contemplation for that type of structure?
Yeah, no, definitely. We actually like agriculture, so we have a few sort of agriculture funds or developments. So as Michael sort of said, things can get a bit lumpy, which again we've got to factor in into and the way we view it too. It's a whole of portfolio sort of view. So when we took core plus satellite as well, whilst we may have that in the total context, we need to understand each and every part of the asset allocation and the exposures. But yeah, look, agriculture, private debt. So we do a lot of shorter term, 1 year, 18 months type of things that go into that unlisted bucket as well. Obviously unlisted property and other little things like that.
Yeah, private debt, I don't think I can get through a presentation these days without someone mentioning private debt, private credit. How long have you been investing in this space? I mean, we obviously are looking at it from the point of view of consulting to our clients. It's been an emergent asset class or sub-asset class. I guess you can view it from the lens of a private variation of fixed income or a debt variation of private equity, depending on your perspective. One of the things I guess that we like about it is that it pulls in many of the benefits of illiquidity that we see in other asset classes into the fixed income space, so the ability to perhaps have a gross up of yield because of the illiquidity premium. One of the concerns I think we have is that it's turning into a bit of a gold rush in terms of providers in this space, and we're not quite sure about the credentials and the longevity of experience that a lot of providers are bringing to market in this space. I just wondered whether we could have a little bit of a chat about private credit and how you look at it, and what have you seen as some of the benefits and some of the pitfalls?
Yeah, and I guess in a rising interest rate environment, I mean, the key thing everyone sort of talks about, you're getting sort of equity-like returns and you've got sort of backing around sort of collateral in that space, so that makes it attractive. To your earlier question, how long we've been doing this, we've had SMAs and running SMAs and MDAs for over 5 years, so probably the private debt stuff is more recent, but we've actually got a dedicated team that also sources that, so there's a team that looks after that. But I think to your point, I guess partnering with the right people is critical. So in my job, and I know there might be other few research managers there, I'm getting a lot of emails and phone calls from a lot of different people I've never heard of. So it is a bit of a gold rush sort of space to get into this. So I think, having the track record, the scale, and people that have access to deals as well is very critical, I think, in this space.
Yeah, and thanks, Danny. They all call me up after they've spoken to you, saying you told them to call me. Um, one of the, I guess we've talked about some of the benefits of illiquid assets, and I guess just focusing on some of the potential issues to deal with, and one of those I'd suggest is not just illiquidity, but pricing and cost structure. And I'd just be interested in your observations of that. We've found, and obviously we're dealing across a whole raft of clients, so we have a significant level of pricing power. But I think one of the attractions for fund managers of trying to target the wealth space with illiquid assets is that certainly they see it as a growth market, but perhaps one that's a little less price sensitive than institutional clients. Now, we don't see it that way. We think it's actually very price sensitive, but I just wonder, what's your observation of this, and, whether you think, fund managers are hitting the mark at the moment on this?
That's why we've partnered with JANA to get the scale. Definitely pricing is important, and the structure of pricing, whether it be just the management fees and then everything else that comes with it. For us, I guess the starting point is, again, if we're looking for a particular exposure and there's nothing else that we can get via the listed market or more traditional means, sometimes it may mean we pay a little bit more. But again, it comes back to that, whether it's risk reward and fees come into it, whether we're going to get our bang for buck to what we're trying to achieve for that client. If it's a specific set of return, but if we can do it in other ways, we'll probably look at that too. So I guess fees do come into it. And obviously we'll do the comps versus everything else in the marketplace in that sector. But it's really, again, coming back to the value for money. And again, if we really wanted that exposure and that was the only thing, sometimes we may have to compromise a little bit on that.
Okay. We might open it up for questions shortly, but I guess from our perspective, we've talked a little bit about MDAs, and that perhaps does open up a window for less liquid, more alternative strategies that aren't able to be accommodated within an SMA structure. A lot of our managed account clients also deal with it a somewhat different way, in that they just run the SMAs as a core strategy, highly liquid because that's the requirement. PDS type structures needs daily liquidity. They all have to be retail PDSs in the underlying strategies. And then for high net worth, family office, not-for-profit type clients that they might be dealing with, using that as a core, they look to populate satellites around that, and they look for opportunistic investments that they feel are going to supplement the requirements. So in the not-for-profit space, for example, it might be focusing more on sustainable type investments or impact investments, where there is certainly illiquidity associated with them, but they serve a particular purpose in terms of the client's ESG requirements. Family office, it might be looking for elevated yield through private credit. It might be some sort of risk diversification that might be required through insurance-linked securities or royalty type funds. So just looking for more niche investments, but they are generally perceived to be sitting outside of a managed account structure as a sort of a supplement to the portfolio. And that's, I think, probably the most common approach that we see. At some stage in the future, we would expect there would be an increase in the rise of wholesale managed accounts. We haven't seen a lot of that at this point in time, but wholesale managed accounts that are specifically targeted to wholesale higher net worth clients that don't need to invest in retail structures, so they can invest in IM type structures, probably onshore feeder funds, but nonetheless, not constrained by liquidity, not constrained by a retail PDS. And I think that would be a very positive development, but we're not at this point as yet. I mean, is that something that you guys, I'm being hopeful here, is that something you guys might be interested in?
No, definitely. And I guess it's also, as I sort of talked a little bit about, as we're getting more the higher net wealth type clients where all their other needs are met, they've got this, whatever huge amounts in their super, they've just got everything already, and sometimes it is client directed. I mean, I'll share it, so I'm not going to name any names, but we've got a particular client, big client, and he's now, sold his business potentially to private equity, and he wants to invest in private equity because he's starting to know that particular sector. So at times it is client driven. Comes back to also some of those other things as well, in infrastructure, healthcare. We are getting a few more of those type of client-driven led, I guess leads to wanting those type of assets. And these are, again, clients that have pretty much everything else covered.
Toby, we might just open it up to questions.
Questions for Michael or Danny? Firstly, apologies that we didn't change the slide from Melbourne. So their names are not Adrian Vidotto and Duncan Smith. Questions about this really important emerging part of the investment market. Because I have one, funnily enough. No, I do have. I do have a question, which is, are you concerned that managers are bringing products to the market that have got liquidity kind of forced into them, that the true underlying assets are illiquid, but that to get something that's sort of investable, it's being bolted together with unnecessary liquidity?
Yeah. So there's an inherent implied conflict there, I guess, isn't there? That on the one hand, you're wanting to invest in these strategies because you're trying to capture an illiquidity premium, and on the other hand, to make them more accessible, the fund managers are designing structures to actually synthesize liquidity. So there has to be a compromise there to some extent. Now, I'm not saying that it's a bad thing at all, because if it can actually open up the market to a wider range of investors and the compromise is not too great, then I think it's a good thing. But I think it's a spectrum there. It's not black or white, and I think you've got to assess the strategies on their individual merits. So, we know, for example, without mentioning names, there's been a couple of very popular, long-standing private equity strategies available to retail investors, monthly or so liquidity. More recently, we've seen others come to market with similar structures in private equity. We've seen that same sort of approach, which uses internal investment structures that are in part long-term, closed-end, and in part more liquid investments to create that structure, becoming more popular across other asset classes. So, I had a conversation yesterday with someone who was coming out potentially with a private credit strategy with daily liquidity. So that's fine at first blush, but we want to really get an understanding of how they've gone about it, what are the compromises inherent in that structure, and whether, in trying to do that, they're just overturning the benefits that we actually see in trying to invest in illiquid assets in the first place. I don't know your thoughts.
I think I agree, definitely on the spectrum. And again, for us too, it's also education for our clients. So we're running a program now we run them every few years, but I think it's probably a little bit more important, especially around that whole property sector again, where clients can't get their monies out at the moment for a whole host of reasons. But so education is important, but we are seeing a bit of a spectrum. And again, I come back down to why are we wanting that particular asset, and how does that fit into the client portfolio? So if it does, as long as we understand some of those components, and if it does fit into what we're trying to achieve, then I would be happy to use it in that context. But yeah, it is. We'll look through sort of that whole gamut of.
And I think that education piece is really important because, even retail clients, you could argue, they require seemingly more liquidity than they really actually need. So, a client that's invested for a long-term superannuation purpose, even once they move into retirement, the time frame of their investment should be still quite long-term. There is a role for illiquidity there, and educating them about the importance of illiquidity in the portfolio, as a virtue rather than a detraction from the value of the portfolio or the value of the investment, I think is probably still work in progress.
Other questions for Michael or Danny? Danny, you mentioned that you sourced private debt. Does that mean, actively looking for managers rather than waiting for the phone to ring, or is this Alteris directly involved in the process?
So we have a team that would do that. So look, we're pretty open. We'll work with managers too. Again, it's how we access what we need to. But we've got a dedicated team that can structure their own, working with other organisations to come up with, like a private debt, whether it be a one-off sometimes, over a number of years, or it could be 18 months, that type of deals as well. So that's done by another team. But yeah, that's something we do. And also, like I said, we're open to just seeing what's out there as well, working with credible managers.
Great, okay.
Okay, thank you, Michael and Danny.
Thank you very much.
Hands together.